What I'm asking for is attention, not panic or blind belief. The story I'm about to detail is not a theory or a hypothetical. It is a measured account of something that has already happened, efficiently and quietly. While the West was distracted, the foundation of the global silver market has cracked in a public, measurable way. On the night of January 9, 2026, the impossible occurred. The Shanghai Gold Exchange, the planet's largest physical precious metals exchange, failed to deliver silver. It did not delay or partially fulfill. It failed because the metal was absent. Buyers demanded 64 metric tons of physical silver. They received 1 ton. That is not a shortage, it is an absence of vault doors opening to emptiness. The math is stark. A 98.44% failure rate. For every 100 ounces requested, less than 2 were delivered. The rest existed only on paper, and paper cannot conduct electricity or keep factories running. This matters not just for the failure, but for what it exposes. For decades, the market operated on a shared illusion that paper and physical silver were interchangeable. Futures, ETFs, and receipts were treated as mere wrappers for the same asset. The assumption was that metal could always move freely to balance demand. That assumption died on January 1 with China's new export licensing regime. The metal didn't vanish, but its free movement ceased. The bridge between East and West was dismantled with paperwork. Consequently, price convergence became impossible. Shanghai began trading at a premium of first modest, then glaring. By late December, the spread reached $14 an ounce. That isn't market noise, it's structural stress. And stress fractures something. What broke was not demand, but deliverability. China, the world's largest refiner, didn't forget how to produce silver. The metal was redirected. We must accept we are no longer in a normal economic cycle, but in a war economy. Strategic materials are not left for speculators, they move to government vaults and defense supply chains. Silver is now treated as ammunition, not jewelry. Look at the global context. Instability in Iran, the unlocking of Venezuela's oil reserves for market stabilization are a euphemism for funding. Modern warfare is metal-intensive. Silver is in guidance systems, radar, communications, and advanced electronics. When nations prepare, they stockpile materials, not hashtags. This is why the Shanghai failure is a signal, not just an event. It shows civilian markets are now competing with state priorities, and civilians lose that fight. When a material is deemed strategic, its availability becomes a political decision. This is a late-stage empire pattern: financialization, debt, currency debasement, and finally, a war economy where resources are commandeered. We are in that final phase. So, what happens next? The delivery failure was not hidden. Traders in Mumbai, Singapore, and Hong Kong know. When physical metal vanishes, price doesn't creep, it jumps. Expectations for Monday, January 13th, are extreme. Analysts discuss a gap up open for silver, a jump straight into the low $80s at the start of Asian trading. In India, forecasts are more dramatic, predicting record highs in rupee terms on the MCX. This confidence stems from one fact: arbitrage is dead. With Shanghai unable to deliver and exports restricted, there's no mechanism to move metal between markets. East and West are now two separate realities. The implications are dire for industrial users. A manufacturer needing millions of ounces to run production lines traditionally hedged in New York or London. But when delivery turns to cash settlement, cash cannot solder circuits or plate contacts. Paper pricing becomes irrelevant. The real price is discovered in panic, outside the exchanges. This is why physical demand is exploding quietly. Institutions and informed buyers are opting out of counterparty risk. Physical metal doesn't default or settle in cash. It just exists, stubbornly real, while paper claims evaporate. There's dark humor here. Silver, long dismissed as boring, is now too strategic to circulate freely. The bigger takeaway: markets don't break because people panic because markets break. Once physical reality asserts itself, narratives cease to matter. Shanghai wasn't the end of the story, it was the opening scene of a new world where strategic materials are hoarded, paper prices diverge, and delivery failures are policy outcomes. Silver didn't just default, it revealed the rules have changed. Pretending otherwise is now the most expensive mistake you can make. Reality stops caring about paperwork. You can shuffle contracts all day, but that doesn't build a solar panel or wire a missile. When production matters, you need metal in hand, and the system is starting to choke. Here is how it plays out. An industrial buyer needs physical metal, not exposure. They go to the futures market and find delivery questionable. They pivot to refiners and wholesalers. When they ask for a price, the answer is blunt. Spot might say $78, but physical is $95. Take it or leave it. They take it. They have no choice. This is the premium explosion once dismissed as fear-mongering. Try buying real coins or bars today. Premiums are $10, $15, sometimes $20 an ounce. Dealers aren't being greedy, they're being rational. They know demand will surge and restocking will be harder. A two-tier market emerges, paper prices floating around $70, $80, and physical reality trading near $90, $100. That gap will widen upward because confidence in paper silver is evaporating. ETF holders start reading prospectuses. Futures traders think about delivery. When too many try to exit at once, you get a run or a bank run. But with silver, the first ones out are fine, the last are left holding claims on nothing. This brings us to the ETFs, where many are exposed unknowingly. Take SLV, the largest silver ETF. It holds roughly 500 million ounces on paper, with JP Morgan as custodian. JP Morgan is believed to control a private hoard of about 750 million ounces. But here is the uncomfortable question: whose interests come first? If you control the metal and a global shortage is exploding prices, do you hand it over to ETF shareholders at $80, or cash settle those shares and sell the metal later at $150 to desperate industrial buyers? If you're a bank, you protect your balance sheet. SLV's prospectus allows for cash settlement in a market disruption, which is now happening. Imagine this: silver on screen says $85. You try to redeem your ETF exposure expecting metal, but you get a check. Meanwhile, physical silver trades above $120, and you're locked out. That's delivery risk, not price risk. Holding an ETF today is a bet that custodians will sacrifice their most valuable asset to make retail holders whole. Some point to alternatives like PSLV, which are structurally different and reduce certain risks, but focus on the phrase, under normal conditions. We are not in normal conditions. In a war economy, sovereign risk trumps every contract. Governments don't ask permission, they take what they need. The only silver without counterparty risk is the kind you control. Now, zoom out to the next pressure point, COMEX. If Shanghai was the first crack, New York is the second. Registered inventory is about 30 million ounces. Open interest represents hundreds of millions of paper claims. Historically, this didn't matter because most contracts never demanded metal. The system relied on apathy. But psychology changes everything. When one major exchange fails to deliver, everyone wants their metal now. If even a modest percentage of futures holders stand for delivery, the math fails. The exchange then has only bad options: raise margins aggressively or declare force majeure and cash settle. Either choice detonates confidence. Delivery notices are coming, and the smart money isn't waiting. They're pulling metal now. You can see it in the data. Registered inventory keeps falling. Metal is being shifted into deliverable status and immediately withdrawn. That's not trading, it's evacuation. Some cling to the idea that a big player like JP Morgan will flood the exchange to save the system. They could, but they won't. Banks exist to extract profit, not save markets. The most profitable move is to let paper fail, let prices reset violently, and then sell physical metal into desperation at multiples of today's price. The current screen price doesn't matter, access does. When physical supply disappears, the quoted price becomes a suggestion. We are entering that phase now. Markets are stopping the pretense. Spreadsheets update and tickers flash, but underneath, the machinery is grinding, slipping, and failing. This is the system breaking in real time because incentives are no longer aligned with stability. When faced with saving a system or themselves, institutions always choose themselves. The timeline for the next failure? It could be days or weeks, but not months. Systems fail when pressure crosses a threshold, and then events accelerate. Today is Sunday. Asia opens first, setting the tone before New York and London come online. That timing is critical. If you hold silver through a paper instrument, you're at a fork in the road. One path assumes the structure will honor its promises under stress. The other assumes the fine print matters more than the slogans. History favors the latter. If you hold physical silver, your job is simple: do nothing. Do not panic sell. Do not be tempted by screen prices designed for a paper market detached from reality. The real price starts with a 1, not a 7. Trading metal for depreciating currency now is like swapping a lifeboat for a coupon book. Fiat can be created infinitely, silver cannot. If you're trying to buy today, you'll face insulting premiums. The spot prices for paper promises the premium is for reality. In a shortage, reality wins. This is not the moment for leverage or clever engineering. Futures that can be cash settled are not protection. If your exposure depends on someone else's willingness to deliver, you own trust, not silver. And trust is the first casualty in every crisis. Expect volatility, media hype, and emotional retail money rushing in late. Prices will spike and pull back as large players try to scare weak hands with paper selling. That playbook only works if you forget why you're here. This isn't the first system failure. Recall the London gold pool in the late 1960s, which suppressed gold prices until vaults emptied and the illusions collapsed. The market split, and gold redefined its value. We're watching the same movie with silver. For over a decade, paper supply expanded profitably, assuming physical metal could always be sourced later. That assumption has failed. The vaults aren't full enough, supply chains aren't flexible enough, and demand isn't patient enough. Another parallel is the 2019 repo market freeze, a collateral crisis where promises failed. Authorities face the same choice: allow failure or print currency. They will print, but printing currency does not create silver, it highlights its scarcity. That's the trap. If they don't intervene, institutions fail. If they do, the currency weakens and hard assets reprice higher. Either way, silver benefits. This is arithmetic, not speculation. As for timing, no one has a crystal ball. But when delivery notices rise, inventories fall, and confidence cracks, things move in weeks, not months. Once the market internalizes delivery risk, price discovery becomes emotional. Fear and scarcity take over. $100 is not outrageous. $150 is plausible. $200 is possible if panic accelerates. Beyond that, pricing loses meaning because you're no longer trading an investment, but holding a strategic asset. This convergence is not coincidence. Export controls removed refined supply, geopolitical tensions spurred stockpiling, and industrial demand rose relentlessly. When these three pressures meet, something breaks. It has broken. Here is the bottom line. A bank run on silver has started. One door is already closed, others will follow. Paper prices and physical prices are about to live very different lives. If you hold paper, you'll get paper outcomes. If you hold physical, you'll get reality. This moment will look obvious in hindsight but feels uncomfortable in real time. You still have a choice, but the window is narrowing, and there is no rewind button.